Kenya's Olympia Capital has come out with its full-year results, posting a 25% growth in pre-tax profit. Group revenues increased 8% to 667 million shillings. And Olympia Capital CEO Matu joins us on the line now from Nairobi to unpack the numbers. A very good morning to you, Michael. Welcome to CNBC Africa. You swung to a profit-making position for the full year. Looking at those group revenues rising by 8% to 667 million shillings, operating profits rising 82% to 54 million shillings. You've embarked on some cost restructuring. Can you just unpack what you've been doing in order to manage your costs?
Basically, we essentially downsized the support systems that we have in the group because 2 years ago we were a much larger group with businesses operating out of South Africa. But now that we're a bit smaller, we wanted to cut down on what we felt were costs that we did not need. So the focus for the year that just ended in February was to focus on reducing costs or eradicating costs that we did not need to support the size of business we are today.
You've been diversifying your revenue streams. You acquired a furniture maker, Natural Wooden Products, in Yokoto, South Africa. Tell us about the rationale behind this diversification and what type of earnings potential do you expect from these two companies?
We expect, you see, first of all, I must say that these were businesses that we owned before, but unfortunately, during the crunch in end of 2009, the business were put into liquidation and we went back and reacquired them. So in the first year and a half or 2 years since we acquired them, which will stride into half of this current financial year, we don't expect them to have contributed in any way. But going forward, we expect them to be positive contributors to both the top line and the bottom line of the business. Basically, our focus is very simple. We are into property and materials that are used in the finishing of properties, floor tiles, window decorating, wooden products, etc. So we are very clear in our focus that we're a property company that also does building materials in the finishing side of the business.
Now, if you look at the construction side of the economy, the government alone has announced big infrastructure plans. Tell us about some of the projects that you're servicing in the next year.
Basically, we have seen an upturn in demand of our products, especially in East Africa, resulting from, one, the growth of the construction industry, and secondly, we're very bullish about what's happened in Southern Sudan and a lot of the developments happening in Rwanda, basically in the East African region. So we're quite confident that we'll have a full order book going forward.
You're diversifying into food processing, so from construction and manufacturing into the food side of the economy. Why do you see opportunity here?
We sort of halted that diversification to food. Basically, we wanted to have a four-leg approach to industries that we depend on. You know, property, building materials, and we're looking for two others. But we have now decided not to make any further investments in the food side until the existing businesses we have are contributing consistent, decent numbers for the group.
You've purchased a tile plant in South Korea. Tell us about your move into manufacturing in Asia, and is this an area that you're hoping to grow manufacturing capacity in?
No, just to correct the misunderstanding, we purchased a plant from a South Korean manufacturer. The plant is in Kenya and is being installed as we speak to replace an old plant that we have.
Apologies on that front.
Yes.
Apologies.
So basically, we are just upgrading an old plant that we have in Kenya with this newer plant from South Korea. We expect that in the current financial year, it will be installed and operating.
Right, let's move on. I was speaking to an investor earlier. They said what they're looking for from management of Olympia is more visibility and how you intend to beef up your return to shareholders. Just looking at your ROE, that's they say it's way below where they expect it to be. It's below the cost of equity. What are you going to do to enhance return to shareholders?
As we speak now, the group board has embarked on a strategic plan with exactly the same sentiments that investor has expressed, that we are sitting on 1 billion shillings of net asset value and we're generating 54 million shilling operating profit. That's too low. I mean, basically, with the kind of asset base we have, we should be looking at about 150 million shillings profit before tax, nothing below that. So the board has put in place measures that in the next 45 to 50 days, we will have a clearly set out strategic plan on how to achieve these returns. Because at this rate, it will be easier to give the money back to the investors for them to invest it directly.
Tell us about some of those measures.
Some of those measures essentially basically it's about looking at what's in the portfolio, and those that can't quite meet the straddle mark, we remove them from the group, and those that are achieving the returns, see how to further enhance them. It's a very basic method of going about it. Basically, you're saying, this is what we expect on our net asset base. If a business cannot achieve that, what can we do to make it achieve it? And if we can't find a way of achieving it, remove it from the group. Get cash for that and reinvest that cash in places where you can achieve the return.